We've talked for the last several months about the overwhelming stimulus from the fiscal policy, whether they be checks in hands of consumers or they be vast amounts, billions and billions of dollars going into several different levels of the corporate environment, as well as healthcare industry, as well as domestic spending. It's just been overwhelming, the fiscal stimulus involved. The Fed has been equally accommodative. There is dovish comments coming out from all the Fed governors. They are committed to staying passive and accommodating. And that is interesting in the current dynamic where we have inflationary pressures coming up, whether it be PPI and CPI, or we look at raw material prices or other input costs that are going into industrial companies today across many different industries. This has been a topic of debate, but it's very clear when you look at the yield curve and the Fed funds futures that no one's actually investing in that outcome of this being anything but transitory. We don't know yet whether that will be a long-term concern, but right now it has no impact whatsoever on the Fed stance to be accommodative. All of these inputs are correlated with an expanding economy, and the economy is expanding quickly. And what we're seeing is that is translating directly into corporate earnings. The breadth of that earnings has been staggering. We've seen a rotation from 2020 to 2021 into a significant number of industries that were not there before, whether they be basic materials related to those input costs, but also in financials and other industries that were somewhat lagging last year. So we're seeing the breadth of those earnings be very positive. The reactions of the stocks is somewhat mixed, but as we look into the second half of 2020 with the backdrop of accommodative Fed, the fiscal stimulus, the economic expansion, the earnings acceleration that is very apparent, and then I would lastly add in easy comps, meaning that 2020 second quarter, third quarter, and even fourth quarter, where the case count was ramping again in the United States, companies are going to have very easy comparison year over year. The net effect of that is, are analysts' expectations too high or too low? So far, we are seeing earnings productivity outpacing analysts' expectations. In other words, it is not all priced in. And it will be very soon that we're going to be looking forward into 22 earnings, and that has a direct effect on valuation and where people think price to earnings ratios will be. All of those add up to a very constructive condition. With a Treasury 10-year bond yield of about 1.5 to 1.7%, this is not historically high. This is actually incredibly low. We know that the Fed funds rate today is near zero, and that is also historically low. So when we look at the potential of rising rates, we have not seen that at all yet in 2021 relative to the rapid expanse of the emergence of a strong economy on the back of the receding COVID concern. If you were to look at a historical view from a cycle like this, where there are glimpses of inflationary pressure coming into order, most economists and most Fed strategy watchers would say that the Fed should be hiking soon. We are not in that condition today. We are in a condition where the Fed has aggressively said that they will be on pause for quite an extended period, and that will continue into 2022. And Fed funds futures certainly point to that, with no hikes between now and mid-2022. Therefore, rising rates is simply not on the table as a material concern. If the 10-year should go up 20 basis points or 30 basis points, that will not have an impact on the corporate bond market. It will not have an impact on the high yield market in any significant way. The other element that I should add, given that we manage most of our funds with a broad capital structure view, we need to note that the high yield market, the corporate bond market, is incredibly good condition. There have been very few, if no defaults in the high yield market of late. That's because of the earnings growth and the strong balance sheets. But also those companies have access to capital. at an ever-accelerating rate. Forecasts are for $500 billion in new issuance in the high-yield market in 2021. That would be an all-time high, and double that of what we've seen on average over the last decade. That means corporations are flush with cash and they can get more at very cheap rates. So these are all constructive elements that we would be looking at as we go into the back half of 2021.
One thing to add besides the positive factors that Doug mentioned was, since those companies are flush with cash and they've cleaned up their balance sheet, we're actually starting to see a pickup in M&A activity. And when we look at what that means to 2022 earnings power, a lot of these acquisitions that we're seeing from these companies are accretive, and in some cases extremely accretive to earnings. So I think that's another leg to earnings growth that people aren't necessarily talking about in the marketplace right now. We are positive on the convertible outlook for the balance of the year. When we look at the US economy, we're seeing an acceleration of earnings, we're seeing an acceleration of revenue growth. We're starting to see companies that underperformed in 2020 start to outperform, especially in an inflationary environment. If you look at consumer discretionary companies, if you look at energy companies, if you look at financials, those have been the leaders of the first half of 2021. As we get to the back half of the year, we expect to see a continuation of this earnings growth and easy comps for these companies. The other thing when it comes to the convertible market has really been the opportunity set that we've seen. 2020 was a record year for new issuance in the convertible market. There was over $100 billion of new issuance, and that's for a market size of roughly $350 billion. Through the first 4.5 months of 2021, we've already done $50 billion of new issuance, so that growth has continued. Why that is so important to the income and growth portfolio is really twofold. First, it brings new opportunity set, but it also brings a new par bond or total return convertible bond that provides that asymmetric risk return with convertible bonds that participate on the upside but have dampened volatility on the downside. So we're really happy with what we've seen in the convertible market, and we expect those sectors that have been leading so far in the first half of 2021 to continue, and the convertible market should benefit from exposure to those names.
With income and growth, it's important to remember that in this environment where investors are challenged with no opportunity to earn income, they're going to have to seek out other solutions. And income and growth is a solution that combines equity, high yield, and convertibles together in a well-diversified platform to achieve that goal of a sustainable income at a higher rate than they might achieve with a standard fixed income tool. That is also going to allow them, of course, to participate in the equity markets. But as the breadth of the market changes, as we look from 2020 to 2021 to 2022, there will continue to be an evolution of the types of companies that are doing well. Earnings are coming fast and furious from all different types of industries today, and income and growth is an excellent place to capture that with the broad diversification amongst multiple asset classes and, of course, deep allocation across those industries within each sleeve.
Allianz Global Investors.